FIFO examples. One identical unit is purchased on each of the following 3 dates and at the respective costs. June 1st at $10, June 2nd at $15, and July 4th at $20. The company sells 2 units during the period. Conclude which inventory items are sold first and which unit remains in inventory, ending inventory, if the company is using the FIFO cost flow assumption. So remember, FIFO is first in, first out. So that means that the items that are purchased first will be the ones sold first. So if the company sells 2 units, then that means they will sell the first 2 that they acquired, and then the most recent one will stay in ending inventory. So the June 1st at $10 and the June 2nd at $15 are both sold. The July 4th unit remains in ending inventory. Chocolate Inc. uses a perpetual inventory system and uses the FIFO cost flow assumption. Calculate the cost of goods sold for the sale made on March 20th. So on the March 20th sale, Chocolate Inc. sold 12 units. That's what we need to know. For this chapter, we're talking about the cost of goods sold. So we're looking at the costs. We're not looking at what they sold them for. That's irrelevant. Here, what we're looking at is the cost of the goods sold. So if they sold 12 units, we have to figure out, looking at the units that are available in inventory, what costs do we use to assign to the units that were sold? So March 20th, 12 units were sold. So since this is FIFO, first in, first out, we're going to look at the first units available. So there are 3 of them, and they were at a cost of $12 each. So that's going to wipe these out to 0. So there were 12 units sold. That accounts for 3 of them. So now we need to look at the other 9. The other 9 will be pulled from the March 15th purchase here. So at $15 each. And then that will leave in inventory 8 at $15. So now if we need to calculate the cost of goods sold, we need to continue here and figure out the total cost of goods sold for those goods that were sold on March 20th. So 3 at $12 is $36. 9 at $15 is $135. Add those costs together. That's $171, which represents the cost of goods sold on March 20th. ABC Company uses a perpetual inventory system and uses the FIFO cost flow assumption. During the month, it had 2 sales. Calculate the dollar value of its cost of goods sold for the first sale made on January 10th. So this is the sale that we are looking at, the January 10th sale, and 11 units were sold. So January 10th, 11 units sold. This is first in, first out. So again, we look to the first units that are available. There are 8 here at a cost each of $12. So there will be 0 left remaining at this cost. We need to have 3 more. So we look at the next available in order. We will pull 3 from there at $15, and that will leave 9 at that cost in inventory. So now looking at the total for our cost of goods sold for this January 10th sale, 8 times 12 is $96. 3 times 15 is $45. So the total cost of goods sold will be $141. Stewart Company's beginning inventory and purchases during the year ended December 31st, 2016 were as follows. So in this table, we see several different things happening. We see the beginning inventory here. We see that there were several purchases made during the year, and then several sales. So since we are focusing on cost of goods sold, we're going to be looking at the dates of those sales. So when we start listing out our information, we're going to look at these dates because those are the dates where units were sold. So it says determine the cost of merchandise sold or the cost of goods sold on December 31st, 2016 using the perpetual inventory system and the first in, first out or FIFO inventory costing method. So the first sale that took place was June 25th. And there were 1,600 units sold. So since this is FIFO, we look to the first units that are available for sale. There are 1,000 there at a unit cost of $50. There will be 0 left here. Okay, but if there were 1,600 purchased, or excuse me, 1,600 sold, we have now pulled 1,000. Here, we're going to need that additional 600 to come from the next available inventory, which will be here. There are 3,000 available. We only need 600 of those, and those are at an individual cost of $52 each. So if we take 600 from here, that will leave 2,400 left. So now calculating out our cost of goods sold here, 1,000 at $50 each is $50,000. 600 at $52 is $31,200. So that is for the sale on June 25th. The next sale is on October 5th. On October 5th, 4,000 units are sold. This is FIFO, so we'll start with those first available up at the top. So there's none left here for us to pull from, so we go to the 2,400 we have available here. So we'll take all of those 2,400, and that is at a cost of $52 each. That will get rid of all of those. There will be 0 left here. We will then have to go down to the next purchase date to see how many units are now available that we have left to go ahead and sell. So here we have accounted for 2,400 of 4,000. That means we still need another 1,600 to fulfill that sale. So we've looked to the next inventory available, which is here. There are 2,600 available here at a cost of $55 each. So we're going to pull 1,600 from there, leaving 1,000 left, and that's at $55 cost each. We multiply this out to get our totals here. 2,400 times 52 is 124,800. 1,600 times 55 is 88,000. The final sale of the year was December 31st. There were 800 units sold. First in, first out. We look to the top to see which are available because we're going in order from top to bottom. What we have available are 1,000 here. So we only need 800 of them. So that will leave 200 for going forward. And those are at a cost of $55 each. 800 times 55 is 44,000. So now we add all of these totals up to get the total cost of goods sold for the year. When we add all of those up, that's going to give $338,000 for the cost of goods sold. Sometimes a problem might ask you not only for cost of goods sold, but they might ask you the amount of the ending inventory. If that's the case, then what you have to look at are the units that you have left to be sold. So we know we have 200 here. So that's 200 at $55. And we have 1,000 units here at $57.68. If we multiply those out, 200 times $55 is $11,000, and 1,000 times $57.68 is $57,680. So that gives you a total in ending inventory of $68,680.